balance sheet. In this short video, I'm going to show you how to prepare balance sheet, and it's very easy way to learn about balance sheet. If you are non-accountant or non-financial manager, you should learn about the company's balance sheet. Let's get started. First of all, in this example, I'm going to show you, you just started some small business, uh, putting your own money, and how it will reflect in the company's balance sheet. So let's say you have started your own business and you put in some money, your own money, and you went to the bank and opened checking account and put in some money. So let's start with that one and see how it will reflect on the balance sheet. Okay, in this example, I'm just using QuickBooks just for the uh, making entries. So we'll just pay attention to the balance sheet rather than how we are making the entries, but I will explain to you about the entries as well. So let's say in this example, you put in $100,000 phone money, went to the bank and did deposit. So first of all, in your balance sheet, you need to have bank account, and you have to show this is my own money and that's your equity. Okay, so let's say you went to Chase banking account, Chase account, Chase Bank. We'll just say Chase Bank. So you open bank account. So you add a new account. Let's just say Chase checking. So you have Chase checking bank account. And let's say in this example, you started out with $100,000, your own money. So in balance sheet, it's interesting that when you put in money, it's debit, and when you take out money, it's credit. And when you put in your own money as equity, it's the credit side. And when you take out money from an equity account, it's the debit side. So in this case, it's your own money. So the credit side is your equity. So as you can see here is the checking account. That's the place where you put the money, and it will say just owner's equity. That's the credit side. So your debit is your bank account, and credit is your equity account. So let's save this one. As you can see here, now we have a new balance sheet here. We start with blank sheet to balance sheet. Now we have some transactions, and we have the balance sheet in here. So as you can see here, $100,000 is your own money you put in, and you put in checking account, that's your bank account, and then on equity side you put $100,000. So in this balance sheet you will see two things, actually three things now. So the asset, that's your bank account, your equity is your the money you put in, $100,000, and so your total asset at this point is $100,000, and your total equity is your $100,000. So at this point you don't have any liabilities, so it's blank in here. So liabilities is like you borrow money or you owe money to somebody, or some vendor, suppliers. That's your liability. And equity is your money you put in, so that's your equity. So in this case, you have 100,000 bank account and 100,000 your equity. So as you can see here, this would balance total assets and total liabilities and equity. This would balance. That's why it's a balance sheet. Okay. So the next step is, let's say you figure out, well, $100,000 is not enough to run this business, and you needed to borrow some money from your friend, let's just say, and you said, well, I need another $100,000 and I will repay you in about 12 months. So you borrow $100,000, you went to the same Chase account, let's say it's $100,000, and this time you borrowed money from your friend, and that's your liability account. So it's a loan account. You borrowed money, that's your loan, and it's the current liability. So current difference between the current liability and long-term liability is this is for long-term over 12 months that you're going to pay it back, and the current liability is basically is under 12 months. Let's say you borrowed this money and borrowed money. Let's say you just want to call it borrowed money from Jim. Okay, so you borrowed another $100,000. You added another $100,000 to your Chase checking account, and that money comes from your friend Jim. And you you told Jim that, well, I'm going to pay you back in 12 months. So now, as you can see here, your bank account went from 100,000 to $100,000, and $100,000 will show as liability from borrowed money from your Jim, and the equity is still the same. Okay, so now if you want to figure out, oh well, what's my equity now? Uh, equity is always your total assets minus total liabilities. The difference is your own money, that's equity. So in this case, $200,000 is your total asset. Liabilities $100,000, subtract $100,000. The difference between 200 and $100,000 is your equity. So that's the amount you put in for this business, $100,000. So whenever someone asks you, well, what's my equity? It's always total assets minus total liabilities is your equity. Okay. So as you can see here, we are stepping up your balance a little bit. And now let's say in this case, well, even $200,000 is not enough, and you need to borrow some long-term money from the bank. So you went to the bank and they said, well, your credit is good enough, so we're going to give you another $300,000 uh, to run your business, and you can just the loan is for 5 years, and you can just pay us back interest or and principal later on. So let's say this one is still the your Chase checking account. Let's say $300,000 borrow from the bank, and in this case it's a long-term loan, still loan. It just happens to be they said, well, you can, it's a 5-year loan term, so long-term liability, borrowed money from the bank, let's say. Okay, so $300,000 is debit. That goes to your bank account, and the credit is the amount you borrowed from the bank. So in balance sheet, always, as I said, whenever you have debit, that's good. It's you added money to your bank, and on the credit side, it's the your liabilities. Refresh this. Now, as you can see here, in bank account, you have $500,000, and $100,000 you borrowed from Jim, and $300,000 you borrowed from your bank, some bank, and $100,000 is equity. As you can see, your total assets still the same, and your total liabilities is it's grown from $100,000 to $400,000 because you added $300,000 more money borrowed from the bank, and your equity is still $100,000. So your total assets, you have $500,000 sitting in your bank account. Now you're ready to start some business. Let's say you want to buy some equipment to run this business. Okay, so you have to use your bank account to pay for this. So in this case now you're buying some equipment and it's your fixed assets. So add new, and it's a fixed asset. This is your major purchase. So this one will have a useful life of more than 1 year. So that's your fixed asset. Let's say you bought equipment to run your business. Okay, so what should be the debit, what should be the credit in this case now? The equipment you added to your balance sheet. It's always the debit side. Let's say you bought for $150,000 of equipment. Equipment is $150,000. You add it to your fixed asset, and you paid by Chase checking account. It's the credit side. As you can see here is asset you added, that's debit. The asset you took out is credit. Refresh this. Now as you can see here, your money went down from 500,000 to 350 because you added $150,000 to your equipment account, and your total assets still the same. So now we have certain transactions, and the balance sheet is stepping up a little bit. Right now we are strictly dealing with the balance sheet transactions only. We haven't decided to expense it, or we don't have any revenue yet, and we're just billing now. So basically, we have the bank account 350, and equipment you added, and you borrowed money from your friend, and borrowed money from your bank, and then your own money you put in. Now, next step would be to let's say you want to spend some money for your business. Okay, so let's just say you spend some money for, let's say, education. Say $1,000 for your continuing education, and you have automobile. You spend $200 for that, and you did some advertising for your business. Let's say $500. And let's say you bought some small computer supply stuff. Let's say another $400. Okay, so let's say altogether you spend about $2,100, and the money came out from Chase checking account. So always it's the credit here. So in the financial statement, debit is your expense and credit is your income. So whenever you have more credit than debit in your income statement or profit and loss, that's good news because you have profit. Whenever you have more debit in your P&L, profit and loss, and less credit, that means you have loss, not good news. So in this case, it's debit only, expense, and the money came out from your checking account. So always, whenever money comes out from a fixed asset or checking account, it's the credit. Whenever you put in money in your fixed asset or bank account, that's the debit side. In this case, you're taking out money, $2,100 for all these transactions. So it's the credit side. Okay, let's save this one, see what happens. Now refresh. So now, as you can see here, your money went down by $2,100, and $2,100 is your net income. In this case, it's a negative here. So far you lost $2,100 and your equity went down by $2,100. So now you have net equity left of 97,900. So as I say, the difference between total assets and total liabilities is your equity. So in this case, you put in $100,000, but you spent $2,100, so your net equity left is 97,900. Okay, so now the next step is what happens. You generate some income. Let's say you did some consulting and brought some business, and is your income here, consulting income, that says $10,000, and you put that money in your Chase bank account. So as you can see here, whenever you bring in business, that's credit to your income account, and it goes to your bank account as deposit, so it's a debit to your bank account. So credit, income, debit, bank account. Okay, so let's save this one and see what happens now. As you can see here, now all of a sudden you have a positive net income of $7,900. So how did you get $7,900? You you brought $10,000 income and $2,100 your expense, difference between income and expense, and this gives you net income. So as you can see here, your net income grew from $100,000 to $107,900. So it went up by $7,900. So this is how you start your balance sheet. And basically you'll have more transactions in assets, more transactions in your fixed asset, more transactions in your uh, liabilities account, and then your equity number will change. So whenever you have income and expense transaction, you'll have the income, the number comes here. So if you want to see the income statement here, let's see the income statement here as well. As you can see here, your consulting income is $10,000, and you spend money on these items, and the income is 7,900. As you can see here, 7,900, it goes to your equity account here. It goes from here to here, and it's balanced. So total asset 507,900, total liabilities 507,900. So it does balance. So that's how you build your balance sheet, and that's how your income statement is entering all the income and expenses here. So this video is more about the balance sheet than the income statement. So this is how you build your balance sheet. So it's very easy to learn, and it's kind of quick. Now you understand the difference between the total assets and total liabilities, and how your equity you see in your balance sheet. So hopefully you enjoyed this quick video, and hopefully you learn about balance sheet. Thank you for watching, and always visit our website vpcontroller.com. Thank you.